If you are a real estate broker and you are not talking to your clients about assumable mortgage options, whether you're working with buyers or sellers, then you are doing them a tremendous disservice. Luckily for you, we're going to take care of that today. My name is Chris Cox, and I am a licensed real estate broker here in North Carolina, as well as a licensed mortgage loan originator. And I also am the education director for Level Up Learning, where we help other real estate brokers get their continuing education post-licensing and soon to have pre-licensing courses here available to you. So let's dive into assumable mortgages. That's what we're going to talk about today. So as we begin, we're going to talk about the three things that we're really going to focus on here for you as a real estate professional, what you need to know to at least have conversations with your clients about assumable mortgages. Number one, we're going to talk about the types of assumable mortgages, what types of mortgages are assumable. Two, we're going to talk about the pros and cons of assumable mortgages, and then we're going to come up with solutions to some of those cons that are available. So let's dive right into what types of mortgages are available. So for the most part, you're looking at any federally backed secured mortgage, so FHA, VA, USDA, anything written after 1989, those are going to be fully assumable. Every single mortgage in those three categories is going to be assumable. Other than that, you're going to see some conventionals that may have some assumability on them. However, most of the time, it is not going to be available, but you still should take a look at that. So those are the three types of mortgages. As far as some of the benefits and drawbacks of those, especially with the VA, one of the things that's kind of a myth going out there is that even if you do know about assumable mortgages, one of the myths that I do hear quite often is that only another veteran can assume that. That is not, in fact, true. Anybody can assume a VA loan, even if they are a non-veteran. However, little asterisk with that, if your veteran wants to use some more of their VA loans for future mortgages, they are not going to have that eligibility returned unless it is assumed by another veteran on there. So you have to look at their certificate of eligibility and what they have available, depending on whether a veteran is going to assume that. FHA, you're looking at all of those being assumable after 1989, and then USDA, it's a great option too. Another benefit of some of these is that some of the fees that are on those are not going to be in the assumption that you're not going to have to pay those, so it does save there as well. So those are the three main types. Like I said, you will also occasionally find a conventional mortgage that is assumable, however, not as often or guaranteed as these three. So what are some of the pros for assumable mortgages? Number one, especially in a high rate environment that we're looking at as of the recording of this in January 2025, is a tremendous amount of savings. And I just want to pull up some numbers here, so I'm not just making these up. But essentially, if someone had a 3.5 rate, and they assume, and that person is able to assume that, let's just say the current market rates were 7%, they are looking at potential savings on a monthly basis on that of around, let's see, let me get this up here. Sorry, I had it up earlier and then it closed down on me. So you're looking at a monthly savings of $801 on that, on a $300,000 assumption. So the difference between that assumed principal and interest is going to be around $1,300. The current market rate at 7%, they're now looking at a $2,100 payment instead. So about an $801 delta or savings in there. That comes out to $9,617 annually. And on the course of a 30-year mortgage, of course, this is going to be, you're not going to have 30 years left on an assumption. You're only going to have to pay what's left. But doing that over 30 years is $288,000. That is why it is so urgent as real estate brokers that we at least are exploring these options. Now, they're not going to work out for everybody. There's going to be some cons that come along with this. But for the most part, you have to at least explore these options and see if they're available. Second pro is lower closing costs. So, as an example with the VA, I believe the funding fee on that is 2.15% normally. With an assumption, there is an assumption fee of about 0.5% currently, with some of the other fees on there. So that's a good amount of savings on closing costs. As an example, on the USDA loan, where there's usually an upfront funding fee on that, that is significantly reduced. I believe it's down to 0 on that. You want to talk to your lending professional and the mortgage holder of the mortgage that's being assumed to find out what those closing costs are. But there can be some significant closing cost savings for someone assuming a mortgage as well. And then often, because the evaluation they know is there, they're not gonna, and the mortgage is already in place, there's not going to be an appraisal involved with that. However, if there is an appraisal, that does move into one of the potential cons. As we're looking at the cons, is if it does require an appraisal and it doesn't meet property conditions for VA or FHA type mortgages, as far as health and safety conditions, who's going to make the repairs on that? So, you got to work out those things in advance. Some of the other cons, and as really the biggest one here, is going to be the gap payment. How is that going to be taken care of? And so the gap is, essentially that is going to be the difference between what the balance is on the mortgage and what the agreed upon market value is of that property. That gap is what additional funds have to be brought by the buyer in order to get into that property. And then the other big con out there is just what I'm trying to get out here with this video is there's just a tremendous lack of knowledge, both from the consumer standpoint and a lot of times from the real estate professional standpoint. So we have to make sure that we are educating our consumers with all of our options and just making sure that they know all of this stuff here. So those are really the two big cons. And then if there is an appraisal and there's property condition issues, those repairs may have to be made before that assumption does happen. So what are the solutions? Because we are a solution-based industry. That's why our clients and our customers depend on us to come up with solutions. So the first solution to that gap is going to be, they make a large down payment. Maybe they're selling a house where they had a tremendous amount of equity and they're able to assume another mortgage. Hopefully, maybe they have that large down payment to cover that gap. That would be a tremendous win-win where, you get someone who is locked in a 3% mortgage right now and they sell that property, or maybe one of the reasons they're not selling that property, even though they need to, is because of that low interest rate. Well, let's take that, a large amount of equity they have, and let's find them another assumable loan. That way they're able to jump into another great mortgage rate and take the equity out of that property and use that as a down payment on another property with a tremendous fixed rate. So we got to start thinking about the box here, thinking out of the box with our solutions. Another solution is a little harder to find right now. I'm confident that there will be some more products that become available for this, and that is someone who's willing to able to get a second mortgage for that gap, whether it's with the initial mortgage holder, so the assumable mortgage holder, or with a company maybe that specializes in that gap payment, a second mortgage, to get that gap covered. And then the third option, again, this is probably a harder one to get, is going to be finding a seller who is willing to finance that gap. Again, it may be harder to find. Maybe it's someone who is, doesn't need that money to buy another house. Maybe they're going into a rental and they can take a note and hold a mortgage on that gap, whether it's a balloon payment or a fully amortized loan. Those are the options you have to work out. But again, we are a solution-based industry. We need to be finding these things out. So that is just really what I wanted to cover today on assumable mortgages. We need to be finding solutions for that. That's why I wanted to put this together today. Hopefully you got some great information out of this and you can go into your next listing or buyer consultation with just a little bit more ammunition to do that. If you like what you're seeing here, go ahead and check out one of these other videos here on that we put on Level Up Learning on our YouTube page here. Give us a subscribe if you want to make sure you're not missing out a video, and thanks for watching.